Hello and welcome everyone back to the Planning Perspectives podcast. I'm one of your two hosts today, Jamie Hopkins, joined by my co-host, Kate Duffy. Kate, great to see you.
Great to see you too, Jamie.
Well, super excited today. We have in studio here a great guest, Andrew Davis, who's our head economist here at Bryn Mawr Trust Advisors. Andrew, I know you're also a Detroit fan, so we will make fun of you a little bit for that.
Yeah.
Welcome onto the show.
Yeah, Thanks for having me.
Yeah, it's perfectly soon, right? You're fresh off the loss.
Yeah.
Well, welcome in today. Excited to have you in. And I think we're going to talk a little bit about the last year kind of macroeconomic landscape and kind of what to look forward to next year. But maybe just give us the 20, 30 seconds, a little bit about who you are as a person so we can kind of introduce you to the world.
Yeah. So thanks again for having me. And my function at the firm is focusing on the macro economy. So really trying to distill from a top-down view, what does growth look like? What does inflation look like? And then ultimately, what does that mean for investor portfolios? Should we own something more of what we like, less of what we don't like, that sort of thing?
Awesome.
So if we think about 2025 and what has happened, there's been no shortage of storylines out there. So give us the top level. What captured headlines? And is there anything that might have flown under the radar that we should bring attention to?
Yeah, well, I think 2025, there was no shortage of headlines like you mentioned, and a lot of them were scary. So for me, the big word that stands out, and I know it's floated around a ton, is resiliency. Because despite of everything happening, right, tariffs, tariff tantrum, if you want to call that, government shutdown, all these things that, are spooky from a headline perspective, but ultimately we've kind of just climbed this wall of worry. And the economy has continued to do well. So I think maybe one thing that slightly underappreciated is in aggregate, the economy is doing well. In aggregate, the consumer is holding up nicely. But there is still this, if you call it bifurcation or K-shaped economy, that is really, I think, contributing a lot to the social unrest. Maybe some of the elections are skewed by it, right? Because people are frustrated if they're in that kind of bottom part of the K, where the upper part of the K continues to spend and really drives that resiliency.
So we do talk about consumers in a different way, and there's a lot of data out there. So we look at housing market, we look at consumer spending and debt, but we also have the divergence of the consumer. So talk about consumer sentiment as well. You have the facts. They're telling one story.
Yes.
And then you have how we feel about everything, which may or may not be telling the same story.
Right. Yeah. And I think to me, it all comes back to inflation. I think that's one of the key drivers of inequality, one of the key drivers of frustration, because ultimately it's easy as an economist to sit back and say, okay, inflation's coming down, or maybe it's moderating. We're at 3%. Taking a step back, for what's kind of remarkable to me is we're ending the year with inflation basically where we started the year. And really, it's not, you go back to like 2017, and this environment is like literally what economists were praying for. Back then, we were talking about inflation was stuck at zero. Should the Fed have like a 3% target and something higher? Well, that's where we are. But I think the frustration that the consumer has is around the price level. And we talk about that all the time. Consumers, like, the inflation rate really doesn't matter to them. It's more about prices. And they notice okay, these items are still higher than 2020. And that's going to drive some of the frustration. I think that's really what's weighing on the sentiment overall. And then you sprinkle in like all the uncertainty with tariffs, all the uncertainty with the government shutdown. It's no wonder that the consumer is a little frustrated. But like you said, Kate, consumption, the economy continues to chug along despite all this stuff. So it really is like, don't get lost in the headlines. Don't focus on the noise. Focus more on the signal. And that's been a tough task, but that's really what we're trying to do.
Yeah, well, let's stay on this topic of inflation for a couple of minutes, because I do think it's one of the 3 or 4 big ones that is on everyone's mind, right? We don't make it through a week without being asked about it from clients, from the media, wherever we go. And to your point, though, one of the things that you brought up was it's really not what the trending inflation number is. It is really the cost of goods in comparison to how much money somebody has. There's also a little bit of just the sticker shock of things, right? That some of the things that we know well, like eggs, milk, repeatable buy things where you have to look at the price every day, you're like, oh, that's gone up a lot. Versus we were talking, we'll get to housing. When housing goes up, we don't always have the same sticker shock because 95% of people aren't looking for houses in any given day. So you have no idea what the house is, right? Yeah. And so you're not like, oh man, like I have to go buy another house this week. It's so expensive.
Yeah.
And we like that part of the inflation because inflation in housing is also bringing up our net worth often. So it's kind of there's different parts of good and maybe bad inflation, as you said, trying to, even 5 years ago saying, how do we drive inflation back up? One thing I find really interesting, and then I'll pass one other thing over to you, is you said, we're kind of ending and beginning the year right around that 3, but that's like the historical 100-year inflation average is kind of where we're running at right now. Like it's really not off of what we would call normal inflation. So what's your thoughts on that versus maybe the 2% target 2% is really below historical inflation.
Yeah. Backing up, the Fed wants, and the reason they have positive inflation target is if you think as a consumer prices are going to be higher into the future, you'll pull some consumption, like you'll pull the trigger on that item. Say like you're looking at it online and you put it in the cart and then people play the game. Are they going to try to, like they're worried about losing me in the funnel, they're going to give me a discount? If you think that's going to happen, you're going to wait. But if you think the price is going to go higher or the sale's not going to happen, you're going to pull the trigger. So that's why the Fed wants that positive target. But the 2%, you're exactly right, Jamie. It's arbitrary. Like, I think it was the US that started this, and then a lot of central banks just adopted that same framework. We're going to have a 2% target. The reason I brought up, 2017, 10 years ago, whatever it was, a lot of people were talking, should we have a higher target? Because 2 is arbitrary to begin with. 3 gives the Fed maybe a little more wiggle room. Ultimately, what you want to avoid is straight up deflation, like not disinflation coming down, but prices going lower, because then no one's going to be consuming. So, if you take a step back, I think it's another example of like, don't get lost on those headlines and spooked by them, because you're right. If we hold a 3% target, if we hold 3% inflation here, which is roughly what we're forecasting, there's actually not a lot wrong with the economy in that type of world. It's only if it's 3% and rising, which, we can get into, but that's not really what we're seeing from the signals.
How do you think the Fed's going to manage inflation next year? Because we think about their dual mandate. We have inflation. We also have maximum employment. So anyone who's looking for a job in a normal environment should be able to find one. But what is 2026 going to look like?
Yeah. So talk about this all the time. It's one of the hot button items that clients want to talk about. And having worked in the CPI office, studied inflation, I can tell you the tariff stuff, what you typically see, at least anecdotally, is that it fades over time. So it's not like a structural, it's not a new wave of inflation. It's a one-time jump up in price, and then it typically fades over time. So I think in the back of the Fed's mind, they're really focused more on the labor market side, because taking a step back, I guess that dual mandate, right? What does that mean? They want to keep price stability. They don't want prices spiraling out of control. I also walk through why they don't want them falling. But then on the other side is the full employment. So I think we're seeing enough, and we think it's kind of a structural slowdown, not a breakdown, but they're seeing enough cooling in the labor market where I think they just walk back towards neutral as 2026 plays out. I don't think they want to be heavy-handed, surprise the market, rock the boat, and kind of just, maybe walk that middle line, walk that middle ground.
And I guess as we'll maybe try to put a bow on the inflation one and move forward to a different topic, but any suggestions from either one of you, maybe on the planning side, Kate, and Andrew, maybe on more of the investment side of how do you position yourself, as a consumer in this inflation environment that we're in today?
Yeah, well, from a portfolio perspective, it's going to drive where we want to tilt. No doubt about that. I think, having a little bit of hedging in there with whether it's tips, treasuries that are inflation linked, I think that can serve a role in the portfolio. And then also we're taking a hard look at real assets, which would do well in an inflationary environment. But if inflation's coming down, as long as the labor market kind of holds steady, which is really our view, then that is kind of a Goldilocks scenario where the Fed can go back towards neutral and the economy can, reach potential growth. I don't know if there's any tie-in from the planning perspective that you're hearing, from clients.
So I think when it comes to inflation and what our budgets are, it really is important to get into the spending component of your plan. Like, what are your base expenditures, the things that you absolutely have to segment money for, the everyday items? And then the levers that we have are the discretionary spending. Where are we spending maybe where we could pull back a little bit? And just being really thoughtful about that. I know sometimes it's hard for people to think about a spending plan versus a budget, but it really is a good tool when we're looking at high inflation environments or trying to be able to maneuver things in the plan.
Yeah, 100%.
Yeah, love that. Well, you mentioned the dual mandate, so let's go there. Let's talk about jobs a little bit. And
sure.
What is the Fed's focus when it comes to jobs right now?
Yeah, so one surprising thing to me is just the resiliency and how low jobless claims have been. So, as far as we see a lot of these layoff announcements, and I think that they're scary in the headlines. You see like Amazon announcing these layoffs. But the thing as an economist, I always want to point out is usually when they mark them as layoffs, it's headcount reduction. So that doesn't necessarily mean firing. It could also mean we're going to pull openings away. We're not going to backfill for a position. And I think there's a little more of the latter that's happening because we're just not seeing it in the data as far as people filing for unemployment insurance. So I think that's that resiliency underneath the hood, but the labor market, make no mistake, has cooled down. But the good thing kind of always comes back to inflation, I guess, is wage growth is still real and positive, meaning it's outpacing inflation, which is helping those with an economy, with a job, right? So I think it's your younger employees that are typically right now struggling. The unemployment rate is ticking a little higher there, but overall the unemployment rate's been resilient. And I think that's what the Fed's kind of trying to balance, right? It's not an easy job, but I think they're doing their best.
Yeah, and I think when you look at some of the big firms where they are doing these reductions in headcount, in my view, is very similar, right? It's elimination of open roles and backfills. They're also spending a lot of money on AI right now. And if you look at how much money these companies are spending on AI, they want efficiencies out of that somewhere. And I think the mandate, probably if you went under the hood in a lot of these companies, is you have to find efficiencies in some of those roles based off the technology and AI that we've spent on. So it doesn't even mean that there's a cost reduction for a lot of these places. I think it's just shifting a bit out there right now from backfills, but trying to say, hey, can we do more with less people, but using this AI spend that we have on the other side to fill in that gap. And I believe that's a bit of the mandate out there in the broader, I'll say, kind of corporate world.
Yeah, so it's interesting because one of the most common cited reasons for this headcount reduction is AI. I'm a little skeptical of that because it maybe end of 2026, 2027, but in 2025, are we really eliminating jobs for AI? I think, make no mistake, workflows changed and we're adopting it. Every Fortune 500 company is asking, how do I adopt it, not whether to? That's definitely real. The demand's real. But as far as job function going away from AI, I think, look, if you're cutting we've seen countless examples. Corporate culture definitely takes a hit once you announce layoffs. So I think a very convenient thing is to pin it on demand, pin it on AI and say, okay, we're trimming back here. But if you do look, a lot of the layoff announcements, a lot of the headcount reduction is big tech. And we know that big tech was hiring white hot, contributing kind of coming out of COVID, 2021, 2022. So I think it's a natural headcount reduction. I agree with a lot of what you said there.
As is the retirement of baby boomers.
Yes.
There's a lot of baby boomers leaving the workforce.
Yeah. So the stat it's wild. It's 13,000 on average per day. They're calling it a silver tsunami. I actually heard that from one of our coworkers, not my term, but so economics is pretty easy. It's supply and demand. We can draw those two lines. But the interesting thing for the labor market is it was always about the demand side. Whether jobs are available, whether companies want to hire someone or don't want to hire someone through the business cycle. I feel like for the first time in a lot of people's professional career, it's a demand side too, where you have the baby boomer, you have that retiring, that drip. You also have deportation going on. So we talked a lot about this as far as people getting spooked around the headlines and the labor market not growing. You actually don't need much month over month job gains to absorb everyone and not have the unemployment rate drift higher, which is what the Fed talks about when they say dual mandate. They don't want to see the unemployment rate drifting higher. So there's not really a whole lot of upward pressure on that right now because of the demand side of things. So it is very interesting, yes.
Well, how about interest rates? So interest rates is what kind of ties all this together a bit, right? Because that's one of the Fed's bigger, kind of levers it can pull on, right? And so where are we today? What is the Fed looking at? The conversations that are ongoing, and I know it kind of changes weekly at this point when new data comes out or doesn't come out, I guess.
Yeah.
Right? We're trying to figure out what's happening next.
Yeah, that's exactly what's going on right now. Absent the data, the market has really said, okay, how can the Fed make a hard stance? And are they even going to cut in December in a few weeks here? But we still think ultimately they're in this rate cutting bias. They want to get rates. I mean, look, at the end of the day, they kind of have this neutral rate. And what do I mean by neutral is that's the steady state rate that they can keep interest rates at. And the economy can just hum along. It's not growing gangbusters, but it's also not falling off a cliff. So you're kind of, view interest rate policy as maybe like a volume knob. And so they can turn it up and down at times. We think that ultimately, any way you dice it, they're a ways off from neutral. So they want to walk it back down. That's what we mean. That's going to be the rate cutting bias. And interest rates will then trickle through the economy and the broader demand of things.
So the housing market is very tied to interest rates.
It is.
And
yes.
we know that a few years back, people locked in bargain basement prices on mortgages in the high 2s, 3%. It really limited supply that's out there because those people theoretically are not going to go anywhere with such cheap money.
Yeah.
But what does that mean for the housing market now and going forward? And there's the age-old question, is it a good time to buy?
Yeah, we've talked a lot and we've joked golden handcuffs as far as like being married to that, sub 3% rate. It's really difficult to leave that. But from a demand side of things, we are still underbuilt as a country. There's a housing shortage. And so that kind of places a floor underneath price is how we view it. I think the worst thing you can get into, and maybe a tie into planning and the advisory side, is trying to time the housing market. That's like a zero-sum game. Ultimately, I think, look, interest rates should drift low over time, whether that means and what that means month to month, quarter for quarter on the mortgage. It's not 1-to-1, but it should maybe come a little lower. I think, maybe there's a floor under prices. We see like more benign growth is what I would expect. So ultimately, as a consumer, probably like back to your question, is a good time to buy. I would say if the home's right for you and it fits in your budget, right? Like the mortgage currently today fits in your budget. You can always like refinance and get out of that mortgage. You can't really, it's harder to get out of the house if it's a bad house. I don't know if you wanted to add anything.
I think that's a really great point because if a house is in your plan, like you just have to look at what the market is presenting as an opportunity right now. And it's planning for it, whatever the actual environment is. You have the two things you can manage. What are interest rates saying now? How does that affect your budget? And being really thoughtful and understanding what you can afford. This is where planning comes into play a lot because we can, run different simulations on what people can afford and get you in the right property at the right time. And like you said, in the future, there always might be an opportunity. Well, there might not always be, but there could be an opportunity for a lower interest rate and to refinance at some point.
Yeah. Yep.
One of my bits of advice on housing that goes contrary to some of the information out there is I actually tell like younger people, like pre-kids, earlier career to stretch more on housing. And the reason is if you look in mass, right, you're probably going to have more flexibility in your discretionary spending at that point, more likelihood that your income's going to go up over time, and probably, right, that house will appreciate over time too. So it's not a bad time to go maybe a little heavier into stepping up one more bedroom or one more cost jump than you were expecting. But I think later on when you're in like mid-career or late career, I'm very against stretching for it because you don't have as many of those things probably in your favor. That peak earning years now are low 50s, late 40s in the US. So if you're 55, you're likely past your highest earning years. So those are coming downward, not upward. So your ability to kind of out earn the pace of your mortgage or a stretch is pretty unlikely at that point. So that's usually not how people present things. But in my view, like, I also use my own story, which was exactly that. Like, the first house I bought felt like a stretch. And then, like, it now you go back and look at it, was like, oh, that was a great purchase, and I probably should have done a bigger house back then.
I think a lot of people are in that camp, but it makes sense. I mean, when you're younger, as far as that illiquidity, doesn't matter. And what is housing? It's forced discipline. You can't skip your mortgage payment. Right. So the better advice, if we could take behavioral out of it, is to save on the house and get aggressive on your stock portfolio.
Yeah.
But there's no forced discipline saying that you have to buy every month other than your 401k. So yeah, I don't disagree with that advice. That makes sense.
Yeah, it's like a lot of the data will argue, right? And you'll see, is it a better time to rent or buy? But if you normalize for people's income, people who buy homes end up accumulating more wealth as their net worth across the board. And most of it goes back, it's really the behavioral. It's not the fact that it was cheaper or more expensive, but the forced payment against your mortgage. You're accumulating this net worth and long-term value inside your house, which tends to work out for people. Otherwise, people spend that money. They actually don't save it, right? It just goes to lifestyle.
Life happens.
Yeah. You eat out more and you have less money in your house. Like, that's the trade-off that you end up with.
Yeah. Yep. Yeah. And I think you're seeing that back to the consumer as far as, where maybe the disgruntled comes from, inflation. It's like people who own a home and are kind of in that capital side of the economy, they're enjoying the wealth effects, right? And unfortunately, the lower end of the distribution, the renters, are really getting pinched here. So yeah, if you have that luxury, I think that's good advice. Yeah.
So if we think about the stock and the bond market, give us a very high level overview of what's happened this year.
Yeah. The interesting thing for me, Kate, is that a lot of investors are, I think, asking themselves about international diversification. And that's always been important to us. We have diversified portfolios. But what's interesting to me is the international markets that have outperformed the US this year. A lot of that happened first 4 months of the year. And it also happened on the back of the worst first half for the dollar in over 40 years. So really, and this is getting technical, maybe a little too deep, but I'll try to pull it out at the end, is if you look at international markets and what really drove returns, it was primarily two things. It was currency, so dollar depreciation helps international markets, and it was multiple expansion, meaning that, like Warren Buffett calls it, that beauty contest. How much are you willing to pay for a stock? What wasn't there, or at least not as much, is earnings growth. And when you buy a stock as an investor, if you're long-term and have the right mindset, you're buying it for that future's earnings growth. Right. So what's really constructive on the US is, we've had a strong run in the market, and we had another, and absent some pullback, looks like we're up about 15% as of this recording. But earnings are growing about 14%. So it's very little beauty contest. It's not dollar dependent, what's going on there per se. And it's all solid fundamentals. So that, I think the headlines would not tell you that if you picked up anything. And then the other thing for investors that are diversified, I mean, fixed income provided kind of like a once in a decade type opportunity. We're seeing, like, across the board, 7%, 6%, 5% returns on something that provides a lot of stability in the portfolio. So 2025 was a great year. And then looking ahead to 2026, look, maybe some consolidation is only natural, just meaning, some period of calm in the market after running up like it did. But that earnings growth profile is still forecasted to be strong next year. So we do think that, cautiously optimistic, if you want to paint us that way, but we are risk on, meaning we do think it's a constructive backdrop for the market.
Well, I was going to say, equity markets, oddly enough, tend to do well with Fed cutting rates. I mean, it's historically, right, when rates are coming down, the markets tend to do well. So that's been kind of in its favor for, presumably the next year and a half also.
Yeah. And the old saying is, don't fight the Fed. We've been saying don't fight the data because the Fed's so data dependent. And maybe back to why the Fed might not cut in December. They have no data. Yeah. But yeah, that's right. I think the Fed is kind of, at the very least, they're removing the headwinds that they were to the market. Whether it becomes a tailwind, we'll see. But I think that's right.
So if we think about our clients who are nearing retirement with what's gone on this year, what we expect to happen next year, what advice would you have for them?
Yeah, well, one, stay away from the headlines, stay away from the news if you can. Enjoy retirement, right? You worked hard to get this nest egg. Let us be. And honestly, it sounds cliche, but that is one of the best advice or the best value add that we can bring, is being that emotional firewall between you and your money.
Mm-hmm.
I mean, countless clients talked, whether it was the tariff tantrum, the government shutdown, even going back here, maybe the election, depending on, which registered party you are. But at the end of the day, like we said, it's been a great year for the market. So look, I think if you're approaching retirement, the last thing you want to do is, and it's very easy, right? Because suddenly you're shifting, and you talk about this all the time, from accumulating wealth to spending it down. So I know it's a very nerve-wracking period of your life, but if you own a diversified portfolio, if you're working with your advisor, you have a thoughtful blueprint, stick to that blueprint. Don't abandon it when this volatility happens, because something's going to happen. It always happens. And yeah, that would be my advice.
It's such a good piece of advice, because when we are planning for clients, we are planning for the volatile years. That's already built into it. So I think that's a great piece of advice.
Yeah, exactly.
So what's one big trend that you're watching closely for 2026?
I think it is the labor market, because the Fed's telling us that they're focused on it. So naturally, that's the area of focus for the market overall too. But that earnings growth profile will be interesting, because right now with interest rates where they're at, it's really the large stocks that are doing really well, and they're able to kind of that flywheel of, we invest in AI, like we talked about, we get rewarded, our stock price goes up, we reinvest, and around we go. And they're still producing earnings, but what hasn't participated as much are the smaller size companies. So maybe if interest rates come down, they can kind of come and enjoy that flywheel a little bit. Those are the two things I would say: labor market and the earnings profile.
Well, Andrew, as we wrap up here today, we always have one question for our guests. What is the best piece of advice that you've ever received or that you've ever given?
So the best piece of financial advice that I ever received was that volatility is the price of admission for compounding long-term returns. And I think that resonates. I forget when I heard it, whether it was around Brexit maybe or that time frame, but time and time again, we're reminded of that.
Yeah.
And even April was a really good reminder. I mean, I feel good, and I think our team does a great job of thinking of the world probabilistically. What we mean by that is not saying it's black or white, yes or no. It's, here's our base case. Here's what could happen to the downside. Here could happen to the upside. How do we want to invest in that? The last thing you want to do is get caught up in the headlines, and then April happens, and suddenly you think every economist is telling me we're heading for a recession. Let's go to cash, or that sort of thing. So yeah, I would say the volatility, embrace it. And that's the best piece of advice on the investment side I've ever gotten.
Yeah, I love that one. And I had a former boss that always said, like, whenever you go through these investing crisis moments, he's like, but when you look back a month afterwards, you're like, man, it was such a good opportunity.
Yeah, 100%. I mean, so many investors, friends, clients even are like, and I'm sure you guys have heard it as well, I'll put this capital to work once this risk goes away.
Yeah.
It's like, well, you don't get rewarded for investing after the risk. You get rewarded for embracing that risk.
Yeah.
And maybe back to that, like thinking of the distributions, having a blueprint, having kind of planned for the volatility, and then being able to remove emotion, right?
Well, Andrew, thanks for coming on the show. Where's a place where people can follow you or connect with you and maybe see some more of your work coming out here in the next couple months? Yeah, so our LinkedIn page is active. We record a weekly to the point video, so you can check that out. It's released every Saturday. And then always visit our website, bmt.com. We share insights there, host webinars and whatnot. Yeah. Awesome. Well, thank you for coming on the show. Our head economist here at Bryn Mawr Trust Advisors. Kate, great job today. Always a pleasure to be here with you in the studio.
Same.
And for everybody else, thank you for listening or watching this week's episode of the Planning Perspectives podcast. Make sure you subscribe so you never miss an episode.
Thank you for listening to the Planning Perspectives podcast. Don't forget to click the follow button to be notified when new episodes are available. Visit our website at www.bmt.com or call us at 833-973-7633. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investments, not a deposit, not FDIC insured, not insured by any federal government agency, not guaranteed by the bank, may go down in value.